Hi, everybody. My name is Andrew Pallas, Certified Financial Planner here at Minnick McGregor Wealth Management. Today, we're joined by my co-host and colleague, Cory Laird, another Certified Financial Planner.
Howdy, y'all.
Welcome to another edition of the Retire on Purpose podcast. Today, we're going to be talking about 401k loans.
401k loans.
All
That's a
right,
very interesting topic.
it is.
What is a 401k loan?
401k loan is borrowing from your retirement account, typically a employer-sponsored plan like your 401k. I think for some people it might sound smart in terms of accessing cash in a quick way, but we'll go over kind of the pros and cons, what it is, and if it is really a good thing to do.
Okay, so I'm imagining that I need $30,000 in my hands, or let's say I need $80,000 in my hands. I've got options that maybe I can take a home equity loan, take equity out of the house, put it on the credit card. That doesn't sound very fun. And then another option among many, you have a 401k loan, the loan from your retirement accounts.
Yeah,
Okay.
so obviously we would recommend taking a look at some alternative options before your retirement accounts, right? Because it can be a somewhat of a behavioral trap in terms of looking at that as a savings account, which we tell people that's not really what it is, an emergency savings account, right?
Yes.
More of a long-term savings account for retirement. But let's just kind of go over some of the logistics of the 401k loan again. So, you mentioned $80,000 as the amount that you want to take out for whatever
As
purpose
an
that is.
example. Yeah.
Yep. But unfortunately, you aren't able to do that. Why is that?
Oh, because there are limits.
There
There
are
are limits
limits,
to what you
right?
can take a loan
You mean
from
I
your
can't
401k.
take all of my 401k money out of
As a
my 401k?
loan, no, you cannot. As a withdrawal, you could, but I think the benefit of taking a loan versus a withdrawal would be the taxable nature of a withdrawal
Hmm.
and the tax-free nature of a loan.
Yeah. So again, the max that you can take out from your 401k is $50,000 or half of your vested balance.
Yes.
That is on a rolling 12-month period, right? So,
Yep.
it could be a higher balance and 6 months ago, but again, it's
So
a
if
12
you
month.
had $80,000 6 months ago and the count went down to
Sure.
40, your loan is 50% of the rolling 12-month period.
Yeah. And again, the vested balances, certain employers will have certain schedules in terms of when that money actually is yours. Again, if you were to leave that employer, that money would come with you. That is really what that term means, vested
Yep.
amount. So again, yeah, let's say I take out $30,000 from my 401k in the form of a loan, goes
Yep.
into my bank account. How does that repayment work? Is it something that I'm making payments from my bank account, or tell me a little bit about that?
Yeah, so it's usually going to come. It's almost always going to come right out of your paycheck stub.
Okay.
So they will usually make you pay the loan off on a 5-year basis.
Okay.
There is a interest rate attached to the loan, but it should be noted that both the payment that you're making and the interest that you're making, principal and interest, is going to you into your 401k account.
Sure.
But it's usually
Sure.
paid out on a 5-year basis.
Sure. Now with that, again, you're taking that loan out, putting in your bank account. You're not taxed on that distribution.
You are not?
So when I'm making payments back, which is coming from my payroll deduction, is that money that I'm putting back in my 401k on again, a pre-tax basis?
No. So there are two, I would say there are two and a half big downsides to a 401k loan.
Okay.
One of them is that when you're making payments back to the 401k on a 5-year basis, that is made with after-tax dollars.
Mhm.
So if it's a pre-tax account, that means that yes, you got that loan out tax-free, but you're making after-tax contributions and interest payments to a pre-tax account. So when you do eventually take that money that you prepaid out of the 401k, when you eventually take that out in retirement, it's going to be taxed again.
Mm.
So it's effectively taxed twice the amount that you're putting back into the 401k as a loan. So that is numero uno in terms of
I would say the big
downsides.
big downside.
Yeah.
Okay.
The upside, of course, is the interest goes to you. So the cost of the loan in terms of the direct cost, well, there's very little direct cost because the interest that you're paying is back in your pocket.
Yeah, I would say, another downside, like you said, two and a half
Yeah.
is, the opportunity cost, right?
Yeah,
That
right.
$30,000 that you took from your 401k is no longer in the market or working for you. It's in your bank account or being used for something else.
In a normal year, it's going to hurt a little bit. But imagine if you took a loan, let's say April 2025, when the market was down 20%
Sure.
and the market rallied up 25% from there, you're going to feel a little hurt there, a little pain
Yeah.
from taking a loan out and missing that opportunity of that money going up. Yeah.
Okay. So we talked about, what it was, how it works. When might it make sense for someone to take out a 401k loan?
Yeah, so if when does it make sense? I think I would prefer a 401k loan over a credit card loan,
Sure.
just because of the big interest rate chances. So if I say, I'm going to make 10% of this money on average, and the interest is going to cost me, let's say 8%, but if you take that out of the equation, your opportunity cost is really what you're comparing a 401k loan to the actual interest payments of a credit card loan or any loan. So it probably comes down to the opportunity cost
Mhm.
versus the interest rate that you would get by getting a traditional loan.
Yeah, and I would say too, these 401k loans can be pretty quick in nature in terms of, getting approved, getting in your bank account. So,
Yeah,
for someone that, like you mentioned, an alternative could be a home equity line of credit.
yeah,
Those can take a little bit longer, and depending on the need for this type of loan, 401k loan might be something that would be a little bit more,
yeah.
advantageous.
I think it should be known that if you're taking out a credit card loan and you don't pay that credit card off, they're probably going to come to you as a lawsuit. You're going to try to reach into your pocket
Right.
that way.
Right.
If you don't pay a home equity loan or a mortgage off, they're going to come for your house. So it's a very different type of loan when you put it into home equity. So that'd be another reason if you're already stretched and you're maxed out on a home equity line of credit and you're having issues paying that off, then a 401k loan would possibly be a better idea here. Because if you don't pay a 401k loan off, what ends up happening?
Well, it becomes taxable
It
too.
becomes taxable.
Yeah,
Yeah,
I mean, if you leave the employer too, right? If you go to a different job and you still have an outstanding 401k loan, that does trigger, taxability on that money that you've taken out,
right.
right? The difference that you've taken out versus what you've put back or paid back to that loan is taxable to you. And if you are under 59 and a half, it's also a 10% penalty on
Right.
top of that.
Yeah. So in terms of timing, if you leave the job or if you retire from a job or get fired from a job, let's say November 1st, when do you need to pay that loan back? Because previously it was a 5-year payment, but only as you worked there was it a 5-year payment. Once you leave the job for whatever reason, how long do you have until
That's a
you need to
great
pay that?
question. 30 days?
No,
What
the
is it?
answer is April 1st
Of
of
the
the
following?
of the following year. Yeah. It used to be the year by the end of the year that you would stop working, but they changed that rule a few years back, and now it's April 1st. But that is not very long to come up with $30,000.
Yeah.
Certainly, if you leave the job December 1st, for
Yeah.
example, gives you 4 months.
I would say the golden rule is to not leave a job with an outstanding 401k loan.
Or just know what you have
Yeah.
and realize that either you're going to make that loan taxable if you can't pay it off in time, or
Yeah, I guess so. That would be a good question is how do I make payments back if I've left the employer?
you send it directly to the custodian.
Okay.
So if you have Fidelity 401k, you're sending it to Fidelity. It's not coming out of your paycheck anymore, but they'll still set up. Sometimes they'll still set up a payment plan.
Okay.
Yeah, so sometimes it's not all due. It's very employer specific, and that should be noted that loans in general are
Yes.
very employer specific. It's not required of them to offer them. It is I wouldn't say it's a benefit, but it's a side benefit that
Sure.
they can't allow people to do.
Right.
Yeah.
Right.
So you can use it as almost a refinance tool.
Sure.
So that if they're going to charge you 8% on a 401k loan and that 8% is going into your pocket and they're charging you 15, 25% on a credit card,
Sure.
then
Yeah, even with the opportunity cost that you're missing out, I think that still would be a
yeah, it's
financially
certainly to look at. And I think to your point, you just really got to be careful not to then build back your credit card back up.
Yeah.
It's at that point is to be a little bit more structured on your budget.
Yeah. And
Yeah.
again, not taking this money out for, an RV or an auto loan or things of that nature. It's
Or just lifestyle expenses,
Right.
going out to eat and things like that.
Yeah, because it can be, vicious cycle if you continue to do that. But
Mhm.
I think we've talked about the 401k loan and process long enough. If you have any questions, if you felt like this was beneficial to you or someone could benefit from it, feel free to like, subscribe, and share. Other than that, we will see you on the next episode of the Retire on Purpose podcast. Thanks, everybody.
Adios.